right, in this video we're going to do something fun. This is going to be a sarcastic, rapid-fire style video, and we're going to go over pretty much the ways to absolutely guarantee that you will fail in trading. So just know that this is sarcastic, and really the whole goal is to, of course, do the opposite. So let's go ahead and dive in. So first thing, if you want to absolutely guarantee that you fail at trading, rule number one is make sure to trade with money that you can't afford to lose. And bonus points if it's rent money. So biggest problem, and I noted this earlier, I was actually talking to a billionaire, and I asked him how he could deal with the risk of actually becoming a billionaire through investing. He actually became a billionaire through investing in Bitcoin. And he said the number one thing that he did was make sure that he wasn't investing any money that he couldn't lose. He made sure he had his rent covered, his overhead covered, and after that, using the money that he could afford to lose, even if he lost every single investment, he'd be just fine. But since he did only invest money he could lose, he never was in a position where he did lose too much money. So definitely, if you want to guarantee failure, definitely invest money you can't afford to lose. Number two is risk management. So actually, we'll kind of keep this so you can't read any further. So skip risk management. This means risk is for boring people who don't want to lose everything in a week. So many people don't realize that traders, there's only one job of a trader or an investor, and that is to be a risk manager. If you're not managing risk, you're essentially not doing, you're giving up on the only thing you can do, essentially, is figure out how much capital you're investing and how much capital you're willing to lose in the end. And of course, if the market goes up, you get to decide how much you keep. But in the end, at the beginning, all you have control of is how much you can risk. So if you're skipping risk management, that is a great way to guarantee your failure in trading. Number three, definitely go all in on a single trade, because diversification is for cowards, right? And it's kind of funny. You'll hear a lot of big investors talk about how they're against diversification, how they say, oh, I think it was Stanley Druckenmiller, even Warren Buffett, they talk about how diversification is a bad thing, because why diversify if you could just put all of your eggs into one basket and watch that basket very closely, right? But there's a huge caveat to that. Of course, if you put all of your eggs in Bitcoin and watched Bitcoin closely since 2011, you'd be killing it. But the problem was not that. The problem was finding Bitcoin. How many other assets were out there besides Bitcoin? Of course, in the cryptocurrency space, there weren't that many, but there's so many other assets. To assume that you're just going to catch the right asset is pretty much a guaranteed way to failure, unless you are just lucky, right? And banking on luck, not necessarily the best trade. All right, number four. Revenge trade immediately after a loss. So for those of you who don't know what revenge trading is, it means that you take a loss and the first thing you try to do is try to recover that loss. So nothing says solid strategy like doubling down on a bad decision. So most people, when they do take those losses, they want to get it back as quickly as possible. And what happens is they're usually not being patient and waiting for a setup again, and they're getting chopped out. The big thing with setups is that setups often do take time. We're waiting for the markets to develop. So if you don't wait for your setup again, and you probably didn't get in on a good setup, the likelihood of getting right back in after a loss or trying to add your size to get back that loss is going to help you get towards failure. All right, number five. Ignore your stop losses. Fear is for stops are for quitters. Real traders go down with the ship. So the big psychology with stop losses is that stop losses are there to stop your losses. I think it's a psychological thing. I think it matters what kind of circles you've grown up in. We hear the word loss and we assume that a loss is a bad thing, right? We don't want to lose. We always want to win. We want our sports teams to win, but a stop loss is not losing. Actually, a stop loss is winning. So if you don't allow your stops to get hit, the odds are you're going to probably have a larger loss, or you need to reevaluate where you're putting your stops in general. Number 6, over leverage every single position. 100x leverage is the coolest thing to a casino on your laptop, or the closest thing to a casino on your laptop. So I think also a lot of people misunderstand what leverage is actually for. People think that leverage is for, say you have $10,000 and then you have 10x leverage. You can now trade with $100,000. Yeah, that's possible, right? But that's really not what leverage is there for. Leverage is for being able to, really the first way it was introduced was actually for hedging. So if you had all of your money or most of your money in positions and you wanted to hedge those positions by taking the opposite side, you would have to put up more money somehow. But with leverage, you would actually be able to add or hedge those positions, add to the opposite side without having to add more money into your account. So, and that's not that dangerous of a play, right? Because you are essentially trying to become neutral in the market. So if the market turns around, that's really where you're just going to be neutral in that case. But what most people think is that leverage is just a way to add more profits. But the thing is it's all a factor of risk to reward. So if you're adding more risk, that doesn't mean that you're going to beat those odds. So if you're risking more on trades, that means when you lose those trades, you're also going to lose more on those trades. So leverage doesn't necessarily help you in those instances. You can't just like bypass the risk equation. Now, another thing leverage can be used for is if you are taking very tight stop losses, and if you need to put on a position that, say, maybe you want to risk 1% of your account, that's very small, right? Or that arguably small. Sometimes if you have such a small stop loss, you can't even put on a big enough position to have a 1% risk. So that could be where leverage makes sense. But for a purely gambling perspective, yes, your wins will be bigger, but also your loses will be bigger too. So it doesn't really help you too much. Okay, number 7, buy whatever coin is trending on Twitter. If an influencer with laser eyes said it's going to the moon, how could they be wrong? So a big psychological understanding about this stuff when things do hit Twitter is when there is buzz, that's usually a fact of people who have made money. Why else would you tweet about something? Because either two things: A, you've already bought, or B, you've made a lot of money, which means you've already bought as well. So a lot of times Twitter information is lagging information. All the whales typically have gotten in when it's hot on Twitter. Then you're just looking at, the retail getting in. And usually the retail is wrong. That's usually where the market's going to collapse, and you're usually lagging. Unless you can really, really find the first few tweets, but if something is kind of at already past its inception, you're going to be on the wrong side of those trades most likely. All right, number 8. Trade purely on gut feelings. Forget about the charts, analysis, fundamentals, vibes only. It's really crazy how well this market can start to convince you that people are getting rich all the time off of gut feelings. You hear people, I just like the coin, I just like the stock. That's really just a factor of luck. And to see those people get lucky again and again is very few and far between. Like you can see, some of the early Dogecoin investors, they typically are not that successful after they've gotten that first investment. A lot of these Bitcoin investors, why are they all pure Bitcoin? Well, because they got lucky on Bitcoin and they don't know how to do it again with other coins. So the people that truly have long-term success in this game are the people that have systems and are able to replicate how they found these projects or price points over and over again. All right, number 9. Change your strategy daily. I'm sure everybody's familiar with this, and if you're not, you're probably doing this. So consistency is overrated. The best strategy is whichever TikTok you saw last night. I remember going through a million shorts, reels, TikToks to try to find the best indicator, try to find the best strategy. And the funny thing about this game that I've found, at least in my own opinion, is you really don't need a great strategy, that great of a strategy, to outperform most people. So most traders, why they fail is not because of their strategy. The reason they fail is because they do not execute their strategy properly. They do not manage the risk properly. And if they would just simply do that with a okay strategy, they'd likely outperform most people. That's the crazy piece of it. And a lot of the best traders that I know, like real deal multi-millionaire traders, they actually don't have that good of a strategy. They're just very good at following the rules and executing those rules. So you can waste the next 1, 2, 3 years looking for the best strategy, where you could spend just a few months with a decent strategy and execute that strategy for the next 2. Test, and outperform that person who is just searching for the quote best strategy. All right. Number 10. Refuse to journal your trades. Why learn from mistakes when you can just repeat them? Okay, we're going old school. I apologize. So, refusing to journal your trades. So, a lot of us, you're not going to actually learn what is required for your strategy and how you look at the market unless you actually journal and understand things like, were your entries, did they make sense? Did your stop loss make sense? Did your risk management make sense? Did your trade management make sense? And if you can't find these patterns on what you're doing right and what you're doing wrong, there's no way to start to get close to the truth and actually get some consistency. So definitely, it's not something. I mean, of course, we would all like to journal all the time, super detailed. There's different ways to do this stuff. You can have very complex journals, very simple journals, but the bottom line is you need a way to understand what you're doing right and what you're doing wrong. And if you're not journaling, you're just guessing, right? You don't really know what your best trade, why your best trades are your best trades, or why your worst trades are your worst trades. One thing I did that changed a lot for me was to actually journal my emotions. I would journal my emotions before I got into a trade, after I got into a trade. And the crazy thing is I found out that the emotions that I thought were going to be effective were actually my least effective emotions. I thought if I was excited about a trade, that would be a winning emotion. But after I went through 100 trades, journaling them, I realized that excitement was actually one of my worst emotions. It was my least performing emotion. And the reason I thought it was a good emotion is because I remembered those wins, but I didn't really remember all the losses. And it turned out that being calm and collected was my winningest emotion. All right, 11. Ignore market news completely. Who needs to know when the Fed speaks or when earnings drop? So this is definitely a biggie. You do want to watch out for these big news events, whether it's an interest rate decision. If you're in stocks, you want to watch out for earnings. I actually got hit with earnings today on Carnival. And everything could be looking right, but when you come across volatility at the wrong spot, that's where the market can easily come back and tag your stop loss, reverse if there's unexpected news. You definitely want to keep tabs on the news to make sure that if there is anything big coming up, to make sure your stops are in place, everything's basically in check. Only trade when you're bored, because nothing cures boredom like torching your account. So yeah, most people will learn, and it's just the nature of probabilities, is the more you try to execute your edge without it being there, the less success you're going to have. So if you are bored and are trying to force trades, that by nature means that you're entering trades outside of your parameters, right? Or trying a different strategy that also dilutes your edge. So you got to know that patience in trading is spelled Paytience. So it's spelled with pay. So really, patience pays. And you really have to wait for all of the stars to align. Otherwise, you're not trading, you're just gambling. Hold losers forever. They're not down 80%, they're down they're long-term investments. So there's a saying in trading where traders often become investors, where they just simply don't have stop losses. Their losses become too big, and they're just going to say, hey, I'm just going to start buying the dip. Now, the issue with that is sometimes things do not recover like we expect. We expect, okay, if it's going to dip, sure, in a few months, things are going to recover. But there have been blue chip stocks that take close to 20 years to recover. There's certain drawdowns that happen. There's also projects that never come back. They end up getting forgotten about. So you got to realize things can take way too long to recover. We do want money at some point. So holding losers can actually be, it's pretty much one of the biggest reasons why people fail at trading, because they don't realize this. They think that things will just come up. Also, they think that their life is going to be all roses, that they don't need to worry about that money. But hey, if something's tied up and it's a loser for way longer than you can handle, now you have to sell at a much, much lower price than you could have, right? You could have taken a small loss, but you decided to take a massive, massive loss. Number 14, take profits instantly. Why let winners run when you can grab a $5 gain and brag about it? To be honest, it really depends at who you are in this game. I think you can either be one or the other, where you're either the person that just takes profits way too quickly, you never catch big gainers. But to be honest, most people do not take profits quick enough, and they always let their positions round turn on them. The key is to make it make sense. If the market looks healthy, everything looks symmetrical, the market's not super extended, these are things where maybe taking profits doesn't make sense. But if you're up hundreds of percent, or the market is fully vertical in the air, obviously taking profits might make more sense. Number 15, follow random Discord signals. Some strangers alpha is basically financial gospel. The tough thing that people have to realize about this game is that, one, taking an edge from multiple people, you are now going to put yourself in front of multiple probabilities. And if you multiply probabilities together, more often than not, that means your odds become lower. So every trader is going to have their wins, their losses. If you're taking trades from 5, 10, 15 different traders, you're probably going to have much more losses because you are compounding their losses. And number 2 is, there's so many nuances. What they feel comfortable with, what are the odds that you feel comfortable with that? What type of conviction do you have? Or maybe they had an amazing trade, but now you're going to go all in, and this is their huge loser of the year. Right? If you don't have your own bias in this stuff, you're going to get caught off guard by somebody else's, or the tides. You really want to be in control of your own decisions in this game so that you can very easily protect yourself and follow your own strategy. All right, kind of the same thing. Copying your favorite influencers' trades. What works for them will surely work for you. I give people this really easy idea is, if I say gave a group of 10 people the top performing coins for this next market cycle, and we followed up with these traders in a year, would they all have the same amount of money, right? If we take an interview, hey, you guys had all those coins, they went up whatever percentage, what type of money did you make? Some people would say, okay, yeah, they would all have the same amount of money, but it's totally not true. Some people would sell early, some people would sell late, and some people would actually lose money because they didn't sell, right? The market could have turned on them and they actually lost. So to actually understand what the intention is of these influencers, They may have sold long ago, but they got you in to pump their bags. These are all things that you have to consider. All right, we'll start picking it up here. So ignore risk to reward ratios. Every trade is a sure thing anyways. So this is just a classic make it make sense. If your trade doesn't make sense, if it doesn't really look like the trade can reach certain levels, people have all these crazy expectations for coins, but if it actually doesn't make sense, why get into something like that? Number 18, trade drunk or emotional. Liquid courage, liquidity equals liquidity, right? So this is basically just emotional trading. Like I said, I highly recommend journaling your emotions and realizing how poor emotions are, or at least the ones that we're taught to follow, are. When you feel good, when you feel like this is the best trade, usually those are the worst ones. When you feel like, hey, this trade's going to be sketchy, a lot of times those are the best ones. So you got to realize the emotional game, at least we're conditioned to actually do things the wrong way when it comes to emotions. Number 19, never backtest a strategy. Live accounts are the best testing grounds. So the cool thing about trading is you can actually go back in time and actually test your strategy and see if it makes sense. Now, of course, what happens in the past is not guaranteed in the future. But if you go in the past and you see it over and over and over and over and over again, that what your strategy is actually has some form of an edge in the past. That's better than going in the past and seeing that it's never worked before, ever, right? A lot of us, we find a strategy, we start using it, and we wonder why it's not working when you couldn't even replicate it by looking into past history. Number 20, ignore position sizing. $50 on one trade, $50,000 on the next. Consistency is boring. Jesse Livermore, one of the best traders in the world, he preaches position sizing is the make or break. So if you don't know how to size your positions to where if your position goes against you, you're not going to lose more than you're willing to lose. You have to stop there and already learn how to size your positions, because every time you take a loss, you should know exactly how much money that you're going to lose on that trade, which 99% of traders have no idea. They just get into a trade and pray that it goes up, and they have a certain dollar amount, and usually they go way past that dollar amount before they sell, and they wonder why their account keeps going lower and lower. 21, forget about taxes. Uncle Sam will never notice your tiny trading profits. It's some of the stuff I feel like, well, at least personally, and I think most people, they lose more money trying to avoid taxes than just simply paying taxes. Now, I'm not an accountant or anything like that, but what I knew is I would hold on to positions that I wish I took profit in, but I was afraid of the taxes consequences, when I could have simply lost way less, paid taxes, or got a good accountant and realized and figured out what I could have paid or saved on taxes, rather than just letting my account get annihilated for being afraid of taxable events. Also, when you know you're in the clear with taxes to the best degree that you can, then it's all upside from there. You don't have to worry about some letters in the mail, etc. Number 22, chase pumps, panic sell dumps. Ultimate buy high and sell low strategy. This is pretty much every noob out there in the trading space, is when they see something pumping, they want to be involved, but the odds of being early on seeing something pump is very, very low unless you are more advanced. The most advanced traders, they get in before the pumps and they get out before the dumps, right? So that is really the key. But most people, they get in while the market's pumping and then it dumps very shortly after, kind of blindsiding them. Number 23, avoid sleep to catch every move. Trading zombies perform best. So this goes back to patience, trying to force trades, trying to trade more often. All these things by nature will make you lose money. It's just such the opposite. We think that doing more is better. In trading, it is completely the opposite. This is why long-term investors and swing traders are often much more profitable than day traders. And of course, there's profitable day traders, but it's because of that patient effect. When you start to trade on larger time frames, you have to be patient by nature, and you're going to allow those setups to happen a lot more. Okay, 24, second to last one here. Treat trading like a lottery ticket. Who needs skill when luck exists? Like I said earlier, luck is a terrible business model. Imagine going into business hoping for luck, right? That's really not going to get you far in the business world. It's not going to get you anywhere in the trading world as well. The hard part about this is you can get lucky, and a lot of people they try it again and it doesn't happen, right? How often can you just get lucky 2, 3, 4 times in a row? It's not very likely at all. But the cool thing is when you focus on skill, this doesn't mean that luck doesn't also apply. So if you're managing your risk, if you have a consistent strategy, you can still get lucky, but on the other side, you are managing your risk. So if you don't get lucky, you're going to be just fine. Instead of most of the people that rely fully on luck, if they don't get lucky, they're starting from scratch again. And finally, 25, quit after one bad week. Because nothing screams professionalism like giving up instantly. Trading is a tough game, right? It's mainly a psychological game. And you got to realize there are going to be plenty of losses in this game. There's actually a book called The Best Loser Wins. It's a book about trading. It's a great book. And it's really showing that trading is a losing game. It's all about managing your losses. It's all about surviving your losses, understanding what kind of losses you can take. So it's really about the losses. It's not about the wins. The wins are all upside. You can't control if the market gives you a win, but you can control how big of a loss that you take. So that's the biggest thing, is you have to understand this is a losing game. Just like a lot of things in life. Play sports. How many shots does it take to score, right? In sales, how many no's does it take to get a yes? Just over and over again. If it was that easy, everybody would be billionaires in this game. But when you can understand this and you simply are the person that doesn't give up, that doesn't blow up, that survives the long term, you will be that person that survives longer than everybody else, finds the opportunities that nobody stayed alive for. And that's really a tremendous edge in this game. I think it's actually one of the biggest edges. It is a game of survival. So those are the 25 ways to absolutely tank your trading career, guaranteed. Hopefully you enjoyed. Let me know any questions that you have, and I will see you in the next video.